All right. Welcome everybody. Welcome to this advanced training. Today we're going to talk about illustrating. And I'm going to show you some different concepts about how to illustrate. And we're going to focus on only a few of the carriers just to get you familiar with their software, familiar with how the system works. I'm going to go through Americo, which has a very, very simple way to illustrate. They have a website. I'm going to show you guys how to do that. And then we're going to go into NLG. And NLG is a little bit more, I won't say complicated, but just more, there's a lot more in-depth. There's a lot more customizations that you can do in order to structure a policy the best way for your clients. And it's important for you to understand how the system works so that you know what each of the areas means and what you can do, what you can't do, what you should and shouldn't do. And so I'm going to try to elaborate on some stuff, and I'm going to focus on illustrating NLG for maximum cash value. Okay, I'm going to do regular, but I'm going to focus on maximum cash value. And these types of policies are typically better for your clients in the long run because it allows them to be able to put a lot more money towards their cash value versus the cost of insurance. And there's different ways you can structure it. So depending on the scenario, it will allow you to set it up the best way for that specific client's needs, okay, or that client's specific needs. And anytime that you're doing any type of quoting for insurance or any type of offering a product or something to your clients, it should always be based on their needs, okay? It's very important that you understand that. Most agents have no clue how to properly structure policies. And in turn, it actually ends up being very, very, very bad for your clients in the long run, especially when it comes to IULs. And we're going to get into why in a short few minutes here. So I'm going to start with Americo. Americo is very easy. It's one of our top carriers. And we want to just kind of highlight some of the key features of their illustration software and show you how easy it is in order to get a price and a quote from Americo. Okay, so we're going to go ahead and get started here. I'm going to share my screen and get into here. Let's see, let me get out of this here. Share my desktop. Okay, so I'm sharing the screen. And I'm going to go to Americo. Okay, so for you guys who don't know, Americo is very, very simple. It's called quote.americo.com. So again, you go quote.americo.com and it takes you here. Okay, now most of us are in California, but you can do it for all 50 states or whatever states that you're licensed in. Okay, let's go here. Right? So let's do California. Now, Americo has different products that we can sell. ADB is their accidental death benefit. Okay, so this is basically only accidental death. So what does that mean? That means that unless their policy will only pay out if they die by an accident. So if they have some sort of medical condition and they end up passing away, let's say from cancer or whatever it is, or natural causes, any type of natural cause, then these policies are not going to pay out. It's very, very important that you understand that. And so what a lot of agents will do is they will, in order to help get as much coverage as possible for their clients, is they might get them, let's say, into a term policy, but then also tack on an accidental death policy so that if they happen to die by an accident, which they weren't prepared for it, basically, then they're going to get additional monies, get additional funds for their beneficiaries. So pretty straightforward. 100,000. It's a $25 premium, annual premium of $263. So very, very affordable. Okay, it's pretty straightforward. Now, up to 200,000, $40 a month, 421 annual premium. Okay. Now let's take a look at another option. I'm going to get into the term policies here. So you have your term 100. Okay, your term 100. So let's just show you here. Very, very, very easy. Let's say it's a 30-year-old male, and term policies are great for younger people who are still working, and they want to just have as much coverage for as little payment as possible. And the idea is, instead of putting them into a permanent policy, you put them into a term, and then you basically say, hey, if you were going to get a permanent policy for, let's say, 400,000, I can put you in a term policy for 400,000, and the difference between the whole life cost and the term life cost, you should go and invest that yourself, right? This is where the term buy, or the phrase buy term and invest the difference comes from, right? The idea is that you take that difference and you invest it. So depending on your clients, depending on what their goals are and what their needs are, term is typically very, very good. I will typically suggest to most of my clients that they get a term with a higher death benefit that's really low cost, and then get a smaller policy, a permanent policy that allows them to put more money into a cash value account. So a very, very low death benefit on the permanent policy, but the ability to be able to put in more money into their cash value, so that later that money can continue to grow, compounding, and they can be able to access it tax-free through policy loans later in life and use that as a supplement for retirement. But while they're working, and while they're being, needing the coverage, while they have dependents, while their kids are in the home and all that, they're going to have a higher death benefit on the term. So in case something does happen to them, then the term will be able to cover the difference. But the idea is, eventually they're going to outgrow their term. Let's say they outlive their term, I should say. Let's say they get to their 30 and they get a 30-year policy. So by the time they're 60, their kids are out of the house. They have enough money saved up in their retirement accounts and in their IUL that they don't need the coverage of a term policy anymore, right? Because after that 30 years, it's probably gonna be a lot more expensive to try to get a term policy when they're 60 years old. So let's take a look here on Americo's term policies. So I'm going to see here, but it is a male, 30 years old, standard non-nicotine. There's nicotine and non-nicotine. So basically they're smoker, they're non-smoker. So most people is going to be non-smoker. And we're going to do face amount here. Now, for Americo, on their term policies, they only go up to 400,000. Okay, so if you want a client, if you have a client that wants much larger coverage, 500, 750, $1 million or more of term coverage, you're not going to be able to put them into an Americo policy. You're going to need to go to another carrier. Typically, it's going to be NLG. It's going to be Mutual Trust, probably some of the other carriers as well, like Anico, maybe even a Foresters, and so on and so forth. We also have Cincinnati Life, which has great term policy. So we're going to be showing you guys more of those carriers later on. But for right now, let's look at Americo. Let's just put in 400,000. Now, let's say you try to put in more. Let's say you try to put in a $500,000 policy here or amount. It automatically changes it back. It gives you a little warning. The face amount was decreased to the maximum allowed, which is 25 to 400,000. So 400,000. This right here is the payment mode. So how often do they want to pay? Is it going to be monthly or is it going to be yearly? Weekly last bill, or bi-weekly last bill. I think it's basically every 2 weeks. So for right now, let's just do monthly, just to give you an idea. And we typically just leave these selected the way they are. 30-year, 25-year, 20-year, and 15-year. Okay. Now there's also riders. Okay. Now riders are basically an attachment to the contract, an additional addendum or amendment to the contract, right? And for those of you who don't know, when you get a policy, you have a contract. You have a contract with the carrier, the insurance provider, and the insured, right? The insurance company and the insured. It's a contract that basically says, hey, I'm going to pay you this premium. And Mr. Insurance Company, if I die, you're going to pay my beneficiaries the death benefit, right? It's a contract and they're obligated to pay it. But these riders are additional amendments that can be attached to the contract so that it gives you some additional benefits. Typically, these riders come at an additional cost. In some cases, it's very, very minimal. Like if you want to get a term rider for your children here. So children's term rider, you select that. And I think it goes up to is it 25? It goes up to 15,000. So each company is a little different. So their term rider is basically 15,000 for their children's term rider. And basically what this means is that any of your children that you have, your natural biological children, I think even stepchildren that that you've adopted and things like that, they will be covered as well. But basically, if any one of your kids dies, you're going to get that money, so that help cover their funeral expenses and things like that. So, and the cost is very, very minimal. I'm not going to add it right now, but just to show you, disability income basically says that if you get disabled while this policy is in place, you select how much you want to get back. You're going to pay an additional premium. Let's say, you know what, I want, if I get sick, I want at least $2,000 a month, right? And I want it to pay out for, I don't know, 2 years, right? So basically 2 years of disability income, they'll pay that out. So obviously you're going to pay more in your policy for this type of a rider. Now, waiver of premium, basically what that is, if you are not able to pay or you forget to pay your premium for the month, or for that, for you know, if it's annual, whatever it is, what that does is that basically gives you a grace period that your policy will not be canceled, and it will allow you basically to waive the premium for a specific period of time, let's say 30 days or whatever it is, so that your policy will still remain in force until you're able to make the payment again. So you will pay a little bit more for this, but it's a great option if you, let's say you have a income that's, you know, not set. Let's say you're not an employee, a W-2 employee, and your income sometimes is more, sometimes less every month, or, you know, something happens, some emergency, you just don't have the money to pay it. So this is a good option as well, so that your policy does not lapse. Okay, I'm not going to select that. And then additional insured term. I believe this allows you to add some additional term insurance on top of it. Or I think it's for like, let's say a spouse and things like that. So I'm not going to add this stuff. Basically, I'm going to go back to design just so we can see. So again, 30-year-old male, non-smoker, 400,000 monthly, and I'm going to hit run. So it's pretty easy, right? And it's going to tell you, okay, for 15 years, $55 a month, 30-year is $97 a month. So about $100 a month for 30 years of coverage. That's not bad. Actually, it's kind of bad, but we're not going to go there. The other way you can do this is, let's say you want to, let's say your client just says, you know what, all I have is $50 a month. How much coverage can I get for $50 a month? That's all I can afford. So $50. Okay, so we can just say, okay, I want the premium to be $50 a month. And then you're going to select, okay, I want 20 years, 30 years. So typically, like something like this, I might just say, well, let's just do 20 years and let's just see what that's like. You can add both if you need to. Oh, and this one you can only do one at a time. So let's just do 20. So $50 will get me $258,000 of coverage for 20 years. Let's go back and see, what does that look like for a 30-year? That's $187,000 of coverage for 30 years. And just so you guys know, I mean, how this works, in case you don't know, it's pretty self-explanatory, but I'll just kind of go through this. So what the insurance companies do is they basically have what they call mortality tables. If you went through your courses already, you should have already understand how this works. And so what they do is as they start taking on new clients and they start to evaluate, and they might buy, you know, mortality tables from someone else or whatever it is, but they start to track how often people die. And they have all their stats, right? They're male, they're female, their age, you know, what they do, and so on and so forth. And so what they do is then they start to evaluate and say, okay, well, the average person lives to age, you know, 75 or 80 or whatever it is. Males may live to 75, females may live to 80. That's might be the average lifespan. And then they'll evaluate the risk. And then that's how they determine how much to charge. So depending on their age when they get the policy, depending how long the term is, they'll evaluate and they'll say, okay, basically over that period of time, they're likely to die or not die. And so we can maybe only charge this much a premium, or hey, they're likely to die because they're getting it when they're 50 and they're getting a 30-year policy. They're going to probably not live to 80. So we're going to actually charge this much. And so that's basically what they do. That's what the system is doing. And so whatever those tables or calculations are, the system is running it for you. So pretty straightforward on the term policy. Let's go back and let's just check out another option. I'm going to talk a little bit about this. I'm not going to go into, but the payment protector. So the payment protector, basically what this is a type of policy that will pay you an amount every month if something were to happen, if you get sick or whatever, and you're not able to, to collect a paycheck or whatever. So it's basically going to pay you out a policy in case something were to happen, right? So they're relatively inexpensive, I should say. They're not too bad. But let's say, depending on the amount of income that you want a month, that's going to, obviously cause the amount to go up, or you can get a lump sum death benefit. So basically what this is if you die, your family's going to get a payment per month, or you can choose to give them a large death benefit. But let's say, you know what, I want my family to get several $1,000s a month for the next 10 years, or 20 years or 30 years after I die. So let's just say, you know what, I want my family to get, I don't know, $3,000 a month for 20 years. Okay. And we can probably even check multiple options here. You can even say, I want to get all the way to age 70, whoever your beneficiary is. So let's just say here what that is. We're going to run this. Oh, I can only select one, of course. Let's do 20 years. So if I die, my family will get $2,300. I guess that might be the most that they allow, which is basically a lump sum death benefit of $399,800. So basically that $400,000 for $63. Now, if I go back to design, if I say, you know what, I don't want it to be an initial lump sum death benefit. So let's check it out here. Yeah, see, so for $12, they get 25,000 or monthly income of 144. So let's just see what this looks like. Let's say it's 400,000. Run. $63. So they get initial lump sum death benefit and monthly income of $2,300 for 20 years. And they have some of the same. You can add an accidental death benefit to this one, or you can do a waiver of premium as well. So for this accidental death benefit, only you first agents allowed to sell face amounts between 300 and 400,000. So I might have to reduce that. I don't know what a you first agent is, but that's probably not us. Anyways, so let's go back. Let's do California. Now let's get into another option that's term related. And that is CBO. Okay, so CBO is cashback option, and it basically is a standard term policy. But what this does is it gives your clients all the premiums that they've paid into the policy after their term ends. So let's say they get a 30-year policy. If they have not died within those 30 years, then they get all of their money back that they paid into it. It's a cashback option or return of premiums. These are going to be more expensive. Let's just see what this looks like. Let's do 400,000 so we can compare. So 400,000 monthly. Again, 30-year-old male, non-smoker. Let's run it. Now, if you guys remember, the 30-year on a regular term was $97. So basically for 30 years, for $100 more, they get all of their money back if they don't die. So let's do the math. My phone's in my pocket. So 197, roughly like $200. It's going to be about 70,000 or something like that. 70, maybe 2,000. Let's find out. So let's do 197.50 times 360 months, $71,100. So you can see here $71,100. So they're going to get all of that money back. Now I want you guys to notice something here. 15-year is $587 a month. Okay. Why is that? Why, even though I'm getting a shorter period of time on my term, why is it so much more expensive? Right? 20 years, $379, 25 years, $274, 30 years, $197. And the reason is because, like I said, the insurance companies know exactly how much these type of policies or when people are going to die, right? They have the mortality tables. And so the way the cashback option works is, as you're paying the premium, the insurance company is going to be investing that money for themselves. They're going to be making interest on the money that you're paying. And so the reason why they offer this back is because, hey, they're going to make plenty of money because the likelihood of you dying is low, right? During that period of time, right? And they do the calculations, they know. So if you're only paying for 15 years, they need to be able to make enough money off of your premiums so that it's profitable for them. And so that's why they're charging more, because they know your likelihood of dying within 15 years is really, really low. So they need to make as much money as they can. So they're going to charge you a lot more for these shorter term periods than someone who's getting a 30-year policy. But hey, they're going to have plenty of time to continue to pay. The likelihood of dying is lower. It's still kind of low. And during that time, we'll be able to make enough interest off their money that they're paying us. And then we'll be able to give them all their money back, and it's fine. Because they're going to be making a lot of money off of you. Now, let's just do an example. I have a compound interest calculator just to give you guys an example of why they would want to do this. So let's say you're contributing the 197, and let's say they're earning, I don't know, roughly, let's just say about 6%. It's not even a lot. If they put it in some mutual funds or some low cost index funds and things like that, or some other investments that are earning 10, 15%, I mean, they're going to make a lot of money. But let's just say on the low end, it's 6%. And within 10 years, okay, just to give you an idea, you paid in 23,000. Let's see if this works. I don't know what's going to allow this. It's kind of hard to tell here. Here we go. So you contributed about 23,000, but they're going to make about 7,000, right? And after 20 years of compound interest growth, you would have paid about 47,000, but their profit, again, at 6%, which they could be putting into more, they're going to make about $39,600. So they would have already made 40 grand off of you. And after those 30 years, okay, another 10 more years, they're going to pay you back your 71,000, but they would have made 115. So they would have basically made 115,000 off of your money. So they're making that much off of you paying that extra premium, the higher premium. And so, hey, yeah, we'll give you your 71,000 back. We made 115,000. Again, that's a 6% growth. If it was higher, it'd be even more. If it was a little bit less, they're still making a profit. All right. So that's how that works. So pretty straightforward. Now let's go back. Let's do the CBO 50. Let's just see what the difference is. So again, 30-year-old male, $400,000. Run this. So it's a little bit less. And I think what this is this basically going to pay you 50% of your premium. The CBO 100 basically pays you 100% of your premiums. So it's less money, $150, so about $50 less or so, $47 less. And that's how that works. So you would still get back a good amount. Well, not your entire premium that you pay into, but at least half. All right, now let's talk about when you're trying to do a policy, a whole life policy for your clients. So if it's over someone who's over, I think 55, you're going to do the Eagle Premier, and okay, it's 50, age 50. And so these policies only go to, I think, to like 30,000. If I try to put 40, I'm sorry, 40. Yeah, so he says up to 30,000. So minimum of 5 up to 30,000. monthly premier. They have different one. You have guaranteed, which is basically for those of you not familiar with guaranteed products, they're guaranteeing you to be insured as long as you answer some medical questions, not all of them, but they will pay you. And then depending if you decide not to answer, it'll be what they call like a step up. If you die within the first couple of years, they'll only pay you up to what you've paid into the policy. But after that, it'll continue to go up and you'll get the full amount. So let's just do regular Eagle Premier, 30,000 for a 50-year-old. You're looking at $112 a month. You know, it's not bad for someone that just wants some sort of coverage, right? In case they pass away when they're getting older. You also have riders. You can have a child and grandchild term rider. Back to design. Let's just see what this looks like. Let's say let's say 65, right? And they want a policy. They never planned for it. They never had a term or whatever. Maybe their term ran out. How much does that go up? So they're 15 years older, $188 a month for a $30,000 coverage. I mean, it's not bad because let's say they died within, let's say 15 years. How much are they paying out? So let's just say 118. So you have 188.59. Let's say within 15 years. So it's about 180 months. So this is where you need to understand, because if they do the math, they're going to find out 33,000 they would have paid into it. So if they die, let's say at age 80, they would have paid 33,000 and they're only getting 30,000. So it's important for you as an agent to understand that these whole life policies, these final expense type policies, if your client lives long, more than 15, 20 years, they will likely pay a lot more into that policy than the amount they're going to get back. That's just how it works. But they're only paying $188. So if they die, let's say within 10 years, oh, well, that definitely pays out more than what they've already put into it. So it's important for you to understand how that works, because your clients may question you. But it's just important for you to make sure you're putting your clients in the best policy for them. Now let's go back. Let's try a different one. Let's do the Advantage Whole Life. This is a standard whole life policy, necessarily a final expense type policy. Now let's say they want, I think this one, let's see how much it goes. If I try to do 50,000, yeah, so it's gonna get 500,000. Yeah, I think you can, this one you can actually go higher. Let's find out. So whole life, $500,000 policy for a 50-year-old. It's a lot. 1,238. I mean, that's a lot. I probably wouldn't do something like that for my client. But let's just say they want like a $50,000 policy. Run 50-year-old, $127. And then I think, you know, let's just say 100,000. Right? You don't want 100,000. I want to make sure my family's taken care of. You're looking at $250 a month. Right. And then these do come with the cash value account and everything else. So they will be able to, you know, a portion of that will be going to a cash value account. I'm surprised that Americo doesn't show you that. It doesn't show you what their how much is going into their policy. It doesn't let you adjust it and make it, you know, where more of it's going to the cash value versus more going for the cost of insurance and everything else. So that's just how Americo works. But this is basically what you have for Americo. It's very easy to use. It's very, very quick. Hey, quick, I just want to know, how much do I get back for a term? Or how much do I get back for, you know, the term 125? So it's pretty quick and easy for you to just get a price right away, and you're able to quote your clients right then and there, and you're ready to go. So term 125, 400,000, $91. It's actually less than the term 100. All right, so that's Americo. Pretty straightforward. Now, let's get into National Life. So I went to nationallife.com, and National Life does have an app. Okay, I'll talk about it briefly about the app. It's pretty straightforward. You can kind of see here, it looks like this. NLG agents is what it says, right? So I'm going to click that. Okay, see what it looks like. So it's looking for my face and put my face in it. So it's going to log in and it has all your stats as an agent, but you can go here to down here. There's a little button. Go there. And it's going to say, oh, wait, wrong one. I'll go to home. Right. Yeah. Oh, sorry. There you go. You go here and you can see here it says quick quote. Quick quote. You're going to click that quick quote. And it's going to do its thing. Just hit accept. And it gives you all their options. Flex Life, Peak Life, Basic Secure, their term, and then their Fit Basic or Fit Focus Income. Your Flex Life is typically where you're going to be doing for IULs. A Peak Life, in case you weren't aware, and we're going to go through some of the stuff, but very easy for you to just go here. I just clicked on LSW term. You basically just select their, what they're looking for, their age, their gender, again, what their rating is, whether it's standard, non-tobacco, you have lead, performance, whatever. We just try to do standard. If the insurance company decides to increase their health or whatever, then let them do that, but put them in that standard. You put in the amount that you want. If they want waiver premium, and you get a quote. So for 100,000 for this 40-year-old, and there it is, right then and there. So what their annual premium is or the monthly premium. So 40-year-old for 30 years, $45 for 100,000, right? For annual premium, it's 514 for the year. So pretty straightforward. It's pretty easy to use app. So it's very quick for you to just get the amount, the basic amount for that. Now, one of the things I don't like about this is that, let's say you go to Flex Life IUL, it doesn't give you a lot of options for customizing. It's just the standard, what their standard IUL is. So you're going to quote your clients based on the amount that the death benefit, and you're not going to be able to customize it for maximum cash value and things like that. So it's good just to get a quick price and for you to kind of get an idea of how much it might be, but it doesn't allow you to really customize the policy. Okay, so for that we're going to go into this website. So I'm going to go to agent here, and log in. This is their software. It has all your stuff as an agent. Your dashboard, you can see your business and everything. But we go here, illustrations. Okay, so I'm gonna go to illustrations. And you can have your recent cases that you're working. I was, getting got a policy for myself. You can go to your case list. It shows you all the cases that you've saved, all the different illustrations that you've done. But let's go back to illustrations. I don't know why it does that, but I'm just going to go here. I'm going to go to new illustration. California. You can select any, right? And this shows you all of them if you just want to do IUL or fixed universal life, whole life. So depending, just show me which ones are for the term. But it's pretty straightforward. Just so you guys know, unless you're in New York or doing a policy for New York and you're licensed in New York, you're going to always use the LSW. And it says right here, LSW, LSW, LSW. The ones that say NL, those are for New York. Those are specifically for New York, so we do not use those. Okay, we typically are not doing things in New York. I don't think we have any agents in New York right now. In the future, we probably will. But for right now, just understand that use the LSW. LSW stands for Life Insurance of the Southwest. So that's the one that is licensed in all other 49 states besides New York. So let's just go to a term. And I want to show you guys the difference. So we just saw the Americo pricing, right? 400,000 for a 30-year-old male was $97. So let's go here. Let's do 30-year-old male. Okay. And non-smoker, standard non-smoker. And again, you see here, you have elite non-tobacco, preferred, select, and standard. So we typically, again, try to just say standard. What you don't want to do is put it at elite, which basically means they're super fit, super healthy. You quote them as really cheap price, and the insurance company says, no, actually, we're going to put them at select, or we're going to put them at standard, and then the price goes up. That's a bad experience. I don't think you want to have that conversation with your client, because what does that look like? Oh, hey, you know how I quoted you? It was only $40 for $1 million. Just kidding. It's actually 100 or whatever. That it's not a good experience, right? So just keep it at standard. If the insurance company decides to bump them up, let them bump them up. It'll reduce the price, and it'll be a better experience. Hey, because then you could be like, hey, remember I said it was only going to be $50, but guess what? It actually is only going to be 40. Oh, that's a much better experience and way easier for your client to proceed with the policy. All right, so let's go here. You're going to go to death benefit and funding, right? This is the client information page. Just for your sake, I'll talk about it right now. Typically, the person who's getting the policy is the owner of the policy. However, if they're getting a policy for their children or for a parent or a sibling or their spouse, you can change the owner. So you might say it's an individual, it's a person. You put their information, and they're going to be the owner of the policy. They're going to be managing the policy. They can change the beneficiary and do all that stuff, but the policy is theirs. They're the owner, even though it might be covering someone else, all right, on their policy. So for right now, we'll leave it as same as insured, and you can put it as a trust corporation, depending on your client. We'll go to death benefit and funding. Now, the good thing about NLG is that they obviously allow you to go up much higher than just 400,000 like Americo. I could put $1 million here, right? So $1 million. See, I get no issues or whatever. But let's just compare the price. 400,000 for a 30-year-old male monthly. There also, you can get a discount if you let's say you already have a policy and you get, or their spouse has a policy and you're getting a policy for the other spouse, they'd get a discount here. And similar to Americo, you can actually say, well, based on the premium amounts, let's say I only have $50, I can only afford $50, then the system will calculate how much insurance they can get. So for right now, we'll just do face amount 400,000, and then we're going to go to just to show you the riders, just so you can see. Now, you have the children's rider, just like Americo. I think this one goes up to 15, I think, as well. I don't remember exactly. No, I think actually, I guess you can go kind of higher on this one, but again, pretty straightforward. You can add a term rider, very cheap. You can get like a $10,000 additional term rider for like $1 more, or sometimes even less than that, depending on your age. And they also have the waiver of premium. And then NLG, which is one of the companies that we love to use because they offer all 4 types of living benefits or accelerated death benefits. You have the terminal illness, you have the chronic illness, critical illness, and critical injury. Okay, each of them have very specific needs of when they might be able to qualify. It also allows you to estimate, depending on different ages, on your illustration. So those are the riders that NLG offers. Now, after you're typically, you're going to go to death benefit and funding, and then you're typically going to go to quick view. And quick view just gives you a quick snapshot of the price and how much it's going to be. So if you recall, for a 30-year policy for a 30-year-old male of $400,000, Americo was $97. NLG, $58. NLG has some great term pricing. Okay, and you can see this is very simple. It looks a little complicated just because it's an old, an old style of software, but it's pretty straightforward. Death benefit, you select the amount when they want to pay, monthly or yearly, quarterly, semi-annually. So if you want to do semi-annual, which is every 6 months, you want to do quarter every 3 months, monthly, or monthly group. Well, I'm not entirely sure what that one is, but just for monthly, you go to quick view, and boom, it gives you your price. Now, very interesting. Let's just see, right? So let's compare. Let's change this to specified amount, and remember, let's do $97. Okay, similar to the Americo policy, and let's go quick view. So for $97, which is the same as the Americo, 30 years would get you $694,000. So an additional $294,000 of coverage for the exact same price. So that's a very, very good option for your client if they were a 30-year-old male. So that's term, pretty straightforward. Now, NLG does not offer a ROP or return of premium option. So just know that there's only a couple carriers that do offer that. I think Americo obviously is one of them. Cincinnati Life, I think, has that. And I think Anico might have a return of premium option. So let's do another one. Let's do an IOL. Okay. There is whole life as well. I'm not going to get into whole life. I'm going to do IOL since that is one of the big products that we offer to our clients. So I'm going to get a male. Let's do 30 years old again. Standing on tobacco. Go to death benefit. So these are the different sections. We're going to talk about it. Tax and compliance. Every time that you illustrate something, the system does a test, or there's just different tests that it can run to see if you are abiding by the rules that the IRS has set forth so that you don't MEC, which MEC stands for Modified Endowment Contract. Basically, that's the rules that say you can only put so much in a policy per year or per 5 years or within 7 years. And you can't put any more. If you do, then it basically, it no longer is going to get qualified as a, with the tax benefits of an insurance policy. Instead, it's actually going to be turned into a investment account because you put too much money into it. And so the government has rules that they say you can only put so much into it because it's a life insurance policy. It's not an investment. So just know that these are the different tests. So guideline premium test or the cash value accumulation test. Also has the MEC avoidance. You can basically say, yeah, you know what? I don't want to MEC. Adjust the face amount of the policy or adjust the premiums downward. That's typically what it's going to do so that you don't MEC. Now, and here's the death benefit area. This is where you're going to select how much coverage they're going to get. We'll go into that in a bit. You have different options. You have the minimum death benefit max cash value. Let the system calculate that for you based on the target premium or based on the premium that you select. So you can say specify amount. We'll get into that in a little bit. You can say based on the target premium, tell me how much coverage I can get based on the amount that I can pay. You also have the death benefit options here. So for permanent life insurance policies, whether that's a whole life, IULs, or fixed universal life, any type of universal life, any type of permanent policy, you can choose to say, I want the death benefit to be level, meaning doesn't matter how much I have in my cash value account up until that face value of insurance that I'm getting, it's not going to change. That if I get $500,000 coverage and it's level, if I have $100,000 in my cash value account, my death benefit is still going to be $500,000. What does that mean? That means that my family, if I die, will only get the death benefit amount of $500,000, regardless of how much I have in my cash value. Well, you might say, well, what does it mean? That's my money. I'm putting it in there. I should get both. Well, basically what it's doing is you're only getting charged for the difference because you're basically self-insured for $100,000 that you have in your cash value account, and you're going to be paying life insurance for the difference, the $100,000 to $500,000. So you're only going to be paying for $400,000 of life insurance every month, the cost of insurance, or every year, whatever it is. So that's how that works. So as your cash value continues to grow and your death benefit is level, that means you're paying for less and less insurance every year as your cash value continues to grow. Eventually, you have a point where your cash value is higher than your death benefit. And so now your death benefit starts to climb at the same rate. And so you're basically not really paying for life insurance. You're just paying administrative fees to have that and get the tax benefits, the not having to pay income tax when you take it out as a policy loan. But that's how that works. Now, what's the other option? The other option is called increasing. Okay. Increasing basically says, I want $500,000 of coverage. And as I continue to add money to my cash value account, then I wanted to grow with it. So if I started with $500,000 and now I have $100,000 in cash value, my death benefit is actually $600,000. And I'm paying for that difference. You're paying for that full $500,000 as it continues to grow. Eventually, what will happen is it can continue to just keep going all the way up and you're going to keep paying for that. But what I like to do and what I like to tell my clients to do, and my agents as well, is to make this change. Have it be increasing while you're building up the policy so that, let's say, you have a low death benefit and you want to put in as much money in your cash value account. Have it be increasing while it's growing, while you're paying the premiums. And let's say, you know what, I only want to fund it until I hit 60 or I hit 65 when I'm ready to retire. After I retire, I don't want to pay any more insurance anymore. I want that cost of insurance to come out of the cash value interest or whatever that I'm earning. So I can be like, well, okay, at age 65, and age stands for age, or you can put, I think just the age or is it maturity? No, yeah. I just put age 65. I think if I put a number, that means the policy year. So let's just say I want it increasing into age 65, and I'll show you what that looks like. The next area is the premiums. This is where you're going to select how you want to pay the premiums or how much premium you're going to pay. Here you select when you want to pay. So annual, semi-annual, 6 months, 3 months, or monthly. And if you were converting a policy from a term into a whole life, you would check this. But here's where you select how much you want to contribute towards your policy. I'm going to go back to none here. And let's say I want to get a $500,000 policy. Let's just do 400 so that we can see the difference. So I can go target premium, and basically when I hit target premium, the system is going to calculate how much the premium should be based on the death benefit that I have. So I'll go to quick view. And so for $400,000 of permanent coverage, my premium is $269. That's the target premium. And you can see here is that, for the year, it's going to be $3,236. I'll get $400,000 of coverage, but I have it increasing. So the cash value that I'm going to have in the account is going to be $2,000. So basically I paid $3,236, and the cost of insurance basically cost me, what is that, about $1,200, let's call it $1,180 or whatever it is. And then the rest of that money went to my cash value. And so now my death benefit is going to increase by that cash value, so $402,000. And you can see as my cash value continues to grow, my death benefit continues to grow, right? I have it increasing up until age 65. And then from that point on, it just stays level. It does continue to grow because my cash values continue to grow, and I have less insurance, or that's that 400,000. If you see here, 400,000 basically is the amount that I'm paying for, because it's no longer increasing, it's now level. Let's go back. Now, one thing to consider. Let's say I want to put more money in my cash value, right? I told you that first scenario, you paid $3,236 and only $2,000 ended up in your cash value. That means you paid a good amount for the cost of insurance. Let's say I want to put that $260 or so in premium, but I don't want to pay that much for insurance. I want more of my money to go to my savings account, my cash value. So you see here, I have face amount right here, and we put it at just 400,000. But you know what? Let's say I want to do 200,000 of a face amount, permanent value, and then I'm going to put this, use this box here, this additional protection benefit. What is that? What is that? Additional protection benefit, or APB rider, provides death benefit protection at a lower cost than the cost of the base policy. It can therefore increase the total death benefit protection without significantly increasing cost. Enter the desired amount of the additional protection benefit rider to be added to the base policy here. So for flex and peak life, the maximum is 3 times the base face amount. For basic secure, which is their fixed universal life, is 1 time. So let's go back. What does that mean? I can get more insurance coverage at less cost. Okay, this is an option that the insurance company gives you so that you can be able to max fund or increase your cash value going to your savings account versus what's going to the cost of insurance. So again, I want that $400,000 of coverage, but I want to pay less for it. I want more of my money to go to my cash value. Now, the other thing I can do here is I can say, you know what? And let's just take a look real quick. I can come back to this. So it wasn't that big of a difference. I paid now $3,120, but now I have $2,389. So an additional $200 or $300 went into my cash value. And again, I have the same amount of death benefit. So why wouldn't you do that? Right? I think it was 269. So we can make this to 269 just to make it more even or equal to the other option. That's pretty close. So yeah, so 2,495. So an additional $420, give or take, is going to my cash value. I'm paying the same amount per month, but now it ends up more in my pocket, right? So that's a good option. And the other thing is it gives you more space to be able to put more money into your cash value. So what do I mean? So right now you have a MEC space of up to 10,000. You can put up to 10,000 per year without it turning into a MEC. Okay, and then you losing those tax benefits of your policy. Now, one thing that's very important for you to know as an agent, when you structure a policy like this, it's better for your client. However, it does come at a cost. It comes at the cost of your commission. Because I don't know if you noticed that target premium of the other way, the $3,236, was what you were going to get paid on as an agent if you just got a standard $400,000 face value amount. Here, because you're getting the cheaper cost of the additional protection benefit, your target premium is less, which means your commission is less because we get paid off of the target premium. So you have to decide what's better. You're going to do what's best for your client, or you're going to try to collect a commission. Our company says we put people over profits. It's not about the commission, it's about the mission. So if we want to help our clients and do the best thing by them, you know what? Be willing to sacrifice some commission to make sure that your clients get put in the right type of policy that's structured the right way so that they can have long-term success. I promise you, if you do right by your clients, more business will come your way. Let's take my word for it. So how else could I structure this? If you recall, when I went on the additional protection benefit definition, it says that I can put up to 3 times the amount on the additional protection benefit of what I have in the face amount. So let's just say they want $400,000 of coverage. Okay, well, let's just say 400,000 divided by 4. So let's just say it's 100,000 here. I'm going to put $300,000 here. Okay, it doesn't do it. Now, if I try to put more, let's just say even 301,000, it's going to give me, it's going to spit out an error. Oh, you can only put 3 times the base face amount. So just remember that. So 300,000. Okay. Now check this out. Same amount that I'm putting in, $269. Go to my quick view. Now look at this. They're putting in that same amount, $328, whatever it is. And an additional several $100s is going to their cash value. And I also want you to notice that their surrender value now it was zero. It was zero on both options before. Now it's actually $1,000. That basically means that the cost of insurance is so low that more money is going to be going. I'm going to be allowed to take out. If I were to cancel my policy this first year, I'd get $1,000 back. Versus if I canceled it in the other options, I'd get $0 back. So this is a good option for your clients. But it's important to know that you're going to be getting paid a lot less in commissions. So it's just something that you need to be aware of, right? But what does this also allow the borrower or the client to do is they're able to actually put a lot more money. And I can illustrate this, right? Remember, the option was to be able to put in up to 10,000 that before they MEC. Now, if you notice their guideline level premium, this is the amount that they can put in every year, the max they can put in, and also your guideline single premium. This basically is the amount that they could put in over a 7-year period, or 7, or is it 5 years? I think it might be 5 years, but no, I think it might be 7 years. What does that mean? That basically means that the rules of the IRS basically say you cannot put more than this much within those 5 or 7 years. Okay, and I'll show you what that looks like. So again, I'm allowed to put in up to 10,000 so I don't MEC. So how much is that? That's almost $1,000 a month. Let's just say it's 800. I think it might be about 850. Go to quick view. Yeah, see, so I was able to put in 10,200. Yeah, so it's within 5 years. So this guideline level premium, if you notice, if you add these up, it's the most that you can put in within 5 years, this guideline single premium. And but what it does allow me to do is within those first few years, I can max fund this policy up to the full amount that the government allows. And so that way my cash value grows as fast as possible. And so this is one of the things that we want to teach our clients is, hey, depending on the amount that you can put in, the most amount, max fund it early on, because the more money you put into it, the more money you're going to earn in interest, and the longer time that you have to grow that interest and grow your cash value, so that later when the cost of insurance goes up, you'll have plenty of money in your cash value account that you won't have to make any more payments. You have to worry about the policy lapsing. So teach your clients to max fund their policies, and you can structure it so that, hey, the most I can put in a policy every year, it might be $5,000. Okay, well, maybe you don't need that much of death benefit, right? If your purpose is to try to maximize the cash value and use it for, living benefits and all that stuff that you want to be able to use it for, then, I don't want to pay for insurance that I don't really need. So I'm going to make sure that my MEC space is only up to that amount that I can put in and max fund it for that year. And that way your customer is not paying for insurance that they don't need. Right? So it depends, again, on their needs. What are they trying to use this policy for? If they're a business and they want to be able to put in all their profits in there and be able to pull it out as they need it, then yeah, you might have really high MEC space because they can put in and fund, $40,000, $50,000, $100,000 a year, no problem. But for someone that might only be able to put in $500 a month at most, then maybe you don't need their MEC space. You only need their MEC space to be up to 6,000, right? The 500 times 12 is $6,000. So you, as an agent, have the ability to customize this policy to make it be the best thing that they need for what they're able to do with the money that they have. So I max fund this thing for $10,200, and look, $9,448 goes into my cash value that I can use, let's say, after that first year. And if I pay it annually, I just make that lump sum payment of $10,200. Boom, I have $9,400 going into my cash value, and the rest is going to the cost of insurance. So that's not bad, because if you think about it, I got $400,000 of coverage, and I paid $10,200 in premium, and basically that cost me $750. $750 a year for $400,000 of coverage. That's not bad. Okay, but again, it works better when they max fund their policy. So you have that option, but also look, you will be getting paid a lot less than commission, even though they may pay extra. you're going to be getting paid this. But I will say that one thing that you will get is additional. As they pay more, you do get a portion of that because they're paying into it. The insurance company is taking a piece and they'll pay that to you. And your residuals, your annual renewable residual income, passive income will be coming in, and you'll be getting paid some of that as well. So that is basically how you can structure a policy. Now, one of the ways you can also illustrate is that, okay, you know what? I only want to pay until I'm age 65. Okay. So I only want to make payments. I'll pay up to $850. And the system will make whatever changes I need to, but I only want to pay to age 65. After that, I want to focus on retirement. I don't want to pay anymore for my insurance. Okay, so I'm going to go to quick view. Okay, so this, I'm gonna have to maybe kind of tweak this down a bit. I'm gonna go here. I'm gonna say, you know what, avoid a mech. I'm just gonna say, yeah, just the face amount. Quick view. So I told the computer, hey, make the change in the face amount wherever you need to, so I never mech. So I never lose my tax benefits. Okay, and so it's gonna do that. And so I'm gonna pay the amount that I can, the most that I can every year up to age 65. And look, I mean, I have plenty of money in here and I'm never going to run out. I'm never going to lapse my policy or anything like that. And look at how much it continues to grow, right? Because they max funded it early. They're putting the most that they possibly can, right? The most that their policy will allow. And, you know, this person is going to be solid if they were to get this type of policy. Hey, low death benefit, and I'm only paying for so much. And this policy is good. But let's say, okay, now I want to illustrate how much can I take out every year. I say, okay, this is where you get into this here, distribution information. So distribution, right now it shows none. So I might say, you know what? I want to specify the amount, or you can use the lifetime income benefit writer to do that. I don't like to use this. Some people do. It's just, it's very easy. It does it for you. Let's just do that. Let's just say lifetime income benefit from age 66 after they stop paying into maturity. And I wanted to, I don't know, increase as it goes, as I get more interest, as I'm earning more interest. Let's just see what that looks like. So I paid up until age 64. What's 64? Okay, let me see if I can change this to age 65. Age 65. See if this will allow me age 65. Oh yeah, see, it doesn't let you. I wonder if it lets me, if I say, you know, I only want to pay to age 64. Okay. So what I did is basically you cannot pay into it and take money out at the same time. It just, the way the illustration software works doesn't let you do that. But so basically I'm saying I'm going to pay to age 64, and at age 65, I'm going to start taking money out. What does that look like? Okay. So I paid up until this year, and then this year I can start pulling money out. So what is it doing? I'm going to be taking a policy loan of $43,000. So that's how much I'm able to take out. $43,000 a year. I mean, that is way more than Social Security. And if you notice, you'll never run out of money. And every year you're going to be pulling money out. You're going to be getting more. It's going to be increasing. First year is 43,000, second is 45,000, third year is 46,000, and on. It's going to continue to climb. As you earn more interest, because remember this policy, you're basically taking a loan out of your cash value, and it's going to continue to grow interest, right? As you're using your money, you're getting paid interest, and we'll have another lesson about how using your policy for your family bank and using money while you're earning money. It's good stuff. But this is what the system is automatically calculating. If you notice, you pull that money here, your death benefit reduced, and it's going to continue to reduce as you use it up. But let's say you die, I don't know, at age 85, because you've been pulling money out every year, a lot more than you put into it, then your death benefit's going to be reducing. So let's say I die 85, you know, I would have taken out quite a bit of money, but my family's only going to get 350,000. Okay. And if you look at the policy, I'll show you kind of what that looks like. This is important for you guys to understand because you might have to explain this to your clients. More importantly, you should know for yourself. Go, if you have a policy, go back and look at your policy. You can pull in, ask your company to run an illustration for you, and you'll be able to see, you know, exactly what the numbers show. So I'm going to go down over here to where it talks about how much you paid into it. So it shows you here how much you've paid into it, right? After the first 10 years, you've paid $85,000, $169,000. By age 65, you've paid $296,000. Okay. Now you're going to start. Oh, this is the guarantee. Let's go to the illustrated amount. Sorry. So paid 296. After the first 10 years, so by the time you're 80, you only paid 296,000 into it, but you would have taken out 442,000. And let's say by age 85, right? You would have pulled out by the time you're 89, you pull out 831,000. So a lot more that you put into it, you're getting back. Okay, so very, very interesting how that works. But again, this is using the lifetime income benefit rider. I don't like to use that, and I'm going to show you why. For some reason, it just doesn't seem to work out. So I'm going to say, you know what, I want to specify the amount. So I'm going to say monthly. You can say annually. I want, what was the first amount? It was like 43,000. Let's just put 45,000. Okay. Policy loan. Quick view. I mean, you have a lot more money in your account. You're taking 45,000 again through policy loans, and you can actually probably pull out more. Let's show this as 50,000. Even let's just do 60,000. $60,000 or $5,000 a month, whatever that is, right? You can do this monthly, you can do it annually. Go to quick view. Okay, maybe we pulled out a little too much too early. So you can basically then illustrate this to show that, you know, you want to be able to pull out 50,000, which is a little over $4,000 a month. And again, it doesn't lapse. But remember the other option, at 85, I only had, my family was only get about 300 something thousand. My family would still get $1 million at 85. And you pulled out, what is that? 20 years at 50,000. It's quite a bit of money. You're pulling out a lot more than you put into it. And that's because of the compound interest growth, right? As you're max funding your policy. So to recap, you can illustrate this stuff for your clients. If you want to show them, hey, I'm pulling out money, but I'm paying it back, or however you want to use this illustration for the distributions. I typically try not to show that on my policies. It's just cleaner that way. But if they want to see it, you can illustrate. You can get very fancy. You can add more rows. Okay, the first year I want to show it, I'm going to pull out 40. The second year I want to put, and you can add a bunch of rows. Boom, 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 boom. And you can show them pulling out more money every year. Or let's see, you know what? I need to pull out every 5 years. I want to pull out 40,000 to buy a brand new car. And you can show them putting that in and paying it back. Right, loan repayment. You can show that, and then you can see it in your illustration how you pull the money out, and then you're paying it back. You're putting more, you know, you're paying more into it, and then again you pull it out, you pay it back, pull it out, pay it back. So you're able to illustrate that. The software is very, very intuitive in that sense, and you're able to customize it to show the best thing for your client. So to recap, you can customize a policy for maximum cash value, right, where they're getting the same death benefit, but depending on how you use this here, you're going to be able to make it be cheaper, where more money is going towards their cash value. Let's say you don't want to keep it increasing. You want the cost of insurance to be as low as possible. So as my cash value goes up, my death benefit stays the same. And, you know, that's a good option. See this one, because I put it as not increasing, it only, and my death benefit is not going up, then I'm not able to put in more money in here. So I'm gonna have to either add more insurance or I put it as increasing. So by doing increasing, what that's doing is I'm basically creating the space of more death benefit, more insurance, which means that the government is going to allow me to put more money into my policy. So I'm able to continue to contribute and increase that, right? But I don't necessarily have to have it increasing all the way up to that point. I can say, you know what, I want to only increase it for I want to be able to max fund it for those first, 20 years, but I'm going to hit 50, right? Because it's a 30-year-old. When I hit 50, that's when I wanted to change, right? And then it allows you, see, but you can see where it adjusted at age 50. I'm not able to put any more because I already kind of max funded it based on the amount of insurance that I have, the death benefit that I have. So this is where you're going to have to, play around with it and try to do the best thing for your client based on what they want to do, based on their needs, based on their income, based on the cash flow, the extra money, the disposable net income that they have that they can use every month, and really what their goals and objectives are. Okay. And again, as you adjust that, keep an eye on this target premium, because you're, even though they're putting in $10,000, you're not going to be getting paid that on commission. You're going to be getting paid what the target premium says. And you will get a little bit more based on them, max funding it, but I would just bank on the target premium amount and base your commission based off whatever percentage you're at versus this amount here. So if I'm at 60% commission with NLG, then I'm going to take $809 times 60%. So 809 times 60% equals $485. So that would be your commission. Okay, so something to consider. Now, again, if you did it the other way, just to remind you, let's say you wanted $400,000 here, 0 here, which is the standard option. Let me know the 0 in here. Okay. Go to quick view. Right, they're putting $850. You're going to be getting paid commission off of 3,236. So 3,236 times 60%, you get $1,900 of commission. So, hey, you have to decide for yourself what you're going to do, what's best for you, what's best for your client. It's up to you. You have that freedom to do that. All right, so hopefully that cleared some things up. If you have questions, you can reach out to me. You can reach out to Rudy. I'm sure he'll be able to help you as well, potentially. I know he's very busy, but reach out to your upline, reach out to your leader, whoever's team you're under, whether that's Ruth, whether that's Fabiana, whoever it is, whoever in the company that that you report to, that brought you into the company. Go to them. They should be learning this stuff. They should already gone through it. They can help you illustrate. But again, you can reach out to us. You can go to info@americaspride.com. You can reach out to me, angel@americaspride.com, and ask the questions. And shoot me an email. Maybe we hop on a quick Zoom call and we can walk through what your specific scenario is, what your client's needs are, and I can help you illustrate a policy that's going to be the best thing for them. 1, that they can afford. 2, that they're able to maximize their cash value. And 3, that it will not mech. And 4, very important, probably the most important one, is that it's not going to lapse too soon. Okay, you can show it lapsing at 100 or whatever. That's up to you, but anything under 100, I'm always going to question it. If it's lapsing at age 95, age 90, age 80, age 85, I'm not going to do that for my client, because what if they live that long? And then they paid all this money into it, and then now all their cash value is gone because the cost of insurance is way too high. And then their beneficiaries are not going to get anything when they die because you illustrated it to lapse and you set them up for failure. So I strongly encourage you guys to really pay attention to that. Pay attention to the mech and pay attention to it lapsing, right? And the system will show you down here. It'll tell you how far it goes, right? Most the standard or the maximum that it will go to is 120 years old. Depending on their age, this might be a lot less as far as years of a policy, but their age will go up to 120. Okay, so if you see it lapsing, it only goes to 89, and it tells you right here, lapse year. Okay, pay attention to that and pay attention to this. These 2 things are key to see how successful this policy is going to be for your clients. okay? And then you can illustrate it where to show it where they're max funding it, or I can say, you know what, I want to have the option to pay more, but I only want the insurance company to charge me every month so much, right? So again, we showed it as $269, okay? You can show it here like this, where, hey, they're only going to pay me this much, but I still have the room. I can still put more into it. But at least the insurance company is only going to be charging me or sending me a bill for $269 every month. But if I want to go and pay $1,000 that month or whatever, then I can do that. I can go on the app as a client. I can pay more. But if you want to illustrate it and make sure that the insurance company is only charging them that much per month, this is how you're going to probably want to do it, where you have a low premium in the illustration, but you can see that they have the MEC space and the guideline level premium space that they're able to put in more. So if you guys have questions about that, again, reach out. I'll be happy to help you guys on that. So I know this was quite a long training. Hopefully it was beneficial for you. Feel free to play around with the software and ask questions if you're not sure. Research it, read things up. I strongly suggest that you probably watch some stuff from Doug Andrew on YouTube. He has a lot of good stuff about why IULs are good and different things. So if you want to do the best thing by your clients and be able to talk to your clients about what's possible with an IUL, then learn for yourself. Go out there and research, do the homework, figure out what to do, what not to do. And so that way you're set up for success to be able to talk to your clients and right there on the spot, be able to give them the information and make yourself look like you're informed, you're the expert and you know what you're talking about. If you come across like that, if you come across like an expert and you're very sure of yourself and confident because you know how it works, you know what to do, what not to do, then it's going to be much easier for you to go out there and sell. And you're going to be able to put and structure your clients and put them in the right type of policy right from the start. And you won't have any issues later on. All right. So with that, thank you very much. And we'll talk later. Peace out.